Basics of Investing. Chapter 10. Investor Psychology. Section 1. Emotional Biases. Emotional biases are the moments when feelings start driving investment decisions more than analysis does. In practice, that can mean fear after a market drop, hope that a losing position will recover, pride after a win, or excitement when a stock is surging. What makes these biases dangerous is that they often feel urgent and reasonable in the moment, even when they conflict with a sound long-term plan. An investor may know the facts, understand the risks, and still feel pulled toward acting anyway. That is why managing emotion is not just about knowledge. It is also about self-control under pressure. In investing, the strongest urge is often not the smartest move. It helps to separate emotional bias from cognitive bias, even though they often appear together. Cognitive biases come from errors in thinking, such as relying on a bad assumption or interpreting evidence poorly. Emotional biases begin with feelings like fear, greed, regret, or overconfidence. Better research and clearer analysis can often reduce cognitive mistakes, but emotional impulses can remain strong even when the facts are clear. An investor may fully understand that panic selling is unwise and still feel unable to tolerate another day of losses. That difference matters because the solution is different too. One problem needs better thinking, while the other often needs stronger discipline and structure. Investors are especially vulnerable to emotional bias because markets constantly create emotional conditions. Losses can trigger fear, regret, and the desire to stop the pain immediately. Strong rallies can create excitement, envy, and the feeling that everyone else is getting ahead. Uncertainty makes things even harder, because when the future feels unclear, action can feel safer than patience. Social pressure also plays a role. When many people are buying or selling together, following the crowd can feel more comfortable than standing apart. Markets are not just numbers on a screen, they are environments that regularly test judgment. That is why investor psychology matters so much in real-world decision-making. One of the most powerful emotional biases is loss aversion. The tendency for losses to feel more painful than equal gains feel rewarding. $1,000 loss usually hurts more than $1,000 gain feels good. That imbalance can distort behavior in several ways. Investors may sell winning positions too early just to lock in a pleasant feeling, while holding losing positions too long to avoid admitting they were wrong. After a decline, some become so cautious that they stop taking appropriate risk, even when their long-term plan has not changed. Loss aversion can even make rebalancing difficult, because selling a recently declined asset feels emotionally uncomfortable. The core problem is that reducing emotional pain starts to matter more than making the best portfolio decision. Overconfidence is another common emotional pattern, and it often grows after a few successful trades. A short streak of gains can create the feeling that your skill is greater than it really is, even when luck played a large role. Once that happens, investors often trade too frequently, take positions that are too large, and underestimate how much downside risk they are carrying. Diversification may start to feel unnecessary, and market timing can seem easier than it actually is. This is especially dangerous because confidence often rises right when caution is most needed. In many cases, overconfidence is simply luck wearing the mask of skill. Loss aversion and overconfidence are especially influential, but they are not the only emotional biases that affect investors. Regret aversion can lead people to avoid making a change because they fear feeling foolish later. Hurting can make the crowd feel safer, even when the crowd is clearly reacting emotionally. Fear often drives selling near market bottoms, when stress is highest and prices may already reflect bad news. Greed and social pressure often drive buying near peaks, when recent gains make further gains feel inevitable. A lot of harmful investing behavior comes from this simple emotional pattern: selling when discomfort is greatest and buying when excitement is greatest. Recognizing these patterns helps investors see that the feeling of safety or opportunity is not always a reliable guide. Emotional bias often follows a sequence, and that sequence becomes easier to manage once you can recognize it. First, there is a trigger, such as a sharp drop, a sudden rally, or a wave of alarming news. Then an emotion rises: fear, pride, excitement, anxiety, and that emotion creates a sense of urgency. Fast thinking takes over, and the mind starts pushing toward immediate action rather than careful review. A reactive decision is made, and if the result happens to work out once, even by luck, the behavior can get reinforced. That is how weak habits become repeated habits. The goal is to interrupt the sequence before urgency turns into action. Consider an investor who bought AR cake at $80, watched it fall, and finally sold at $55 mainly to escape the stress. The key issue in that decision is not whether the fund later recovered towards 75, because hindsight is always easy. The more important question is whether the sale came from a disciplined review or from emotional discomfort. If fear outweighed a careful check of the original reason for owning it, then loss aversion was likely in control. The investor turned a painful paper loss into a realized loss mainly to reduce stress in the moment. Sometimes selling is the right choice, but it should come from process, not emotional relief. That distinction is what protects future decisions. Gains can create problems too, especially when they feed overconfidence. Imagine an investor buying TSLA at $250, watching it rise quickly to $350, and then doubling the position because the gain feels like proof of special insight. The larger bet is not supported by a stronger process, just by stronger confidence. If the stock then falls to $280, the damage is much greater because position size increased at exactly the wrong time. This is how recent success can lead investors to buy high while feeling unusually certain. A profitable trade does not automatically mean the reasoning was excellent. Sometimes a gain is simply a gain, and treating it as proof of skill can be costly. Emotional decisions cannot be eliminated completely, but they can be reduced with good habits. A written investment plan gives you something objective to compare your impulses against. Checking whether an action still fits your risk tolerance helps prevent decisions that feel urgent but are out of character for your goals. It can also help to ask how a neutral observer would view the situation, because emotional intensity often narrows perspective. After major market events, reviewing what triggered your reactions can reveal useful patterns about fear, greed, or impatience. The aim is not to become emotionless. It is to build enough structure that emotion no longer makes the final decision. Many expensive investing mistakes are really emotional mistakes in disguise. Selling after a drop out of fear, buying after a sharp rise out of greed, and trading more aggressively after a win are all common examples. Holding a losing position out of pride can be just as damaging, because it turns ego into a portfolio decision. Even protective tools can be misused, such as setting stop losses so tightly that normal volatility keeps forcing unnecessary exits. What these errors have in common is that emotion is quietly replacing process. Spotting them early matters, because repeated emotional mistakes can do far more damage than any single bad trade. That is a good bridge into the next part of investor psychology, where the problem is not just feeling, but thinking. Section 2. Cognitive biases. Cognitive biases are systematic thinking errors that affect judgment, even when emotions are not the main driver. They come from mental shortcuts, or heuristics, that help us make quick decisions but can distort analysis in complex situations. In investing, these shortcuts often feel logical because they simplify uncertainty into a cleaner story. An investor may rely on a familiar rule of thumb, a memorable example, or a convenient comparison and mistake that shortcut for careful reasoning. That can affect how a business is valued, how risk is assessed, and how much evidence seems necessary before acting. The important point is that a decision can feel rational in the moment and still be biased. That is why awareness alone is helpful but not enough. Emotional and cognitive biases can lead to similar bad decisions, but they begin in different places. Emotional bias starts with feelings, such as fear during a decline or greed during a rally. Cognitive bias starts with flawed reasoning, such as anchoring on an old price or trusting weak evidence too easily. In real investing decisions, the two often overlap and reinforce one another. A person might feel fear and then justify that fear with bad logic, or feel excitement and then search for reasons to support it. Even so, it still matters to identify the source of the problem. If the root issue is faulty reasoning, the answer is stronger analysis. If the root issue is emotional pressure, the answer is usually structure, rules, and patience. Several cognitive biases appear repeatedly in investing. Overconfidence causes investors to overestimate their skill or their ability to control outcomes. Anchoring makes them stick to an initial number, such as a purchase price or a past high, even when that number is no longer relevant. Confirmation bias leads people to favor evidence that supports what they already believe while overlooking contradictory information. Availability bias causes vivid, recent, or memorable examples to feel more important than broader evidence. Hindsight bias makes outcomes seem obvious after they happen, which can create false confidence about future decisions. Each of these biases distorts judgment in a different way, but they all make weak decisions feel more reasonable than they are. Overconfidence and anchoring often work together to distort price judgments. Overconfidence makes investors too sure of their own skill, which can lead to overtrading and unnecessary risk-taking. After a few successful decisions, it becomes easy to confuse luck with ability. Anchoring creates a different problem by tying judgment to an old reference point, such as a previous high price or the price you paid. A stock that used to trade at 100 and now trades at 70 may feel cheap, but that lower price does not automatically mean better value. The business may be weaker, the risks may be higher, or the original price may have been unrealistic in the first place. Good analysis asks what the asset is worth now, not what number feels familiar. Confirmation, availability, and hindsight bias affect how investors gather evidence, judge probability, and interpret results. Confirmation bias encourages you to notice bullish evidence when you already want to buy, while filtering out warning signs that deserve attention. Availability bias makes recent or vivid examples feel more likely than they really are, such as assuming a dramatic recovery story will repeat because it is easy to imagine. Hindsight bias arrives later and makes the final outcome seem obvious, even if the situation was genuinely uncertain at the time. Together, these biases can build a false sense of clarity around a weak conclusion. The danger is not just one bad thought pattern, but the way several biases can stack on top of one another. That stacking effect can make a fragile decision feel unusually solid. A biased decision often unfolds in a recognizable pattern. It usually begins with uncertainty and the pressure to make a choice without complete information. The mind then grabs onto an easy anchor such as a price, a headline, or a first impression, because certainty feels comforting. Instead of examining broader evidence, shortcuts begin to replace deeper analysis. Selective research then increases confidence because the investor keeps finding support for the original idea. If the outcome is favorable, even by chance, that result can reinforce the entire process and make it feel trustworthy. This is why cognitive bias becomes repeatable. The mind remembers the competence, not just the quality of the reasoning. Imagine a stock called Novatech that falls from $120 to $85. Many investors will immediately think it looks cheap, but that reaction may say more about bias than about value. The old high of 120 becomes an anchor, and 85 feels attractive simply because it is lower. But if weak earnings or a damaged outlook justify the drop, then the lower price may be entirely reasonable. Bullish headlines can then feed confirmation bias, while a vivid story about another company that recovered sharply can feed availability bias. If Novatech later rebounds, hindsight may make the original buy seem obvious and strengthen overconfidence. The lesson is that a lower price is not an argument by itself. It is just the beginning of a valuation question. These biases matter because the greatest damage usually comes from repetition, not from one isolated mistake. A single biased decision may only cost a little, but a pattern of distorted judgment can steadily reduce returns over time. Cognitive biases affect valuation, risk assessment, and even the amount of evidence that feels sufficient before acting. They shape whether you buy, hold, or sell, often while making those decisions feel thoughtful and justified. That feeling of rationality is part of what makes them so persistent. Investors rarely say, "I am being biased right now." More often, they feel certain they are simply being sensible. Some habits make cognitive bias much more likely. Ignoring base rates, for example, means overlooking the broader odds in favor of a compelling story. Treating recall as proof of probability is another mistake. Just because an example comes to mind easily does not mean it is common or likely. Anecdotes can also receive too much weight, especially when one memorable success story seems more vivid than a large body of data. Arbitrary anchors like old highs can distort value judgments in the same way, and one of the most underestimated mistakes is assuming that awareness alone will fix the problem. In reality, bias is reduced by process, not by insight alone. Cognitive bias becomes easier to manage when decisions follow a more disciplined structure. Start by writing a clear investment thesis, so you know exactly why you own something and what must be true for the idea to work. Separate price history from business value, because a chart can influence judgment even when it tells you little about fundamentals. Deliberately look for the strongest counter-argument instead of only collecting evidence that supports your view. Use base rates, peer comparisons, and broader evidence so that one vivid story does not dominate the decision. Finally, review the quality of the decision itself rather than judging everything by the outcome. That focus on process sets up the next topic well, because discipline is what turns good intentions into repeatable behavior. Section 3. Discipline. Discipline in investing means following a predefined process consistently, especially when markets are loud, emotional, and distracting. It is not about being rigid for its own sake. It is about using rules so that important decisions are not made by impulse. A disciplined investor stays more consistent under pressure, protects against unnecessary trades, and pays attention to the plan rather than the noise of every price move. This matters because markets constantly tempt people to react. Discipline creates a buffer between what you feel and what you do. Discipline and stubbornness can look similar from the outside, but they come from very different places. Discipline is rule-based, which means a person follows the plan even when doing so is uncomfortable. Stubbornness is emotion-based, which means a person keeps holding or defending a decision mainly because admitting error feels painful. A disciplined investor exits when the rules say to exit, even if hope suggests waiting longer. A stubborn investor holds and hopes, often while telling themselves they are being patient. The difference is not persistence alone. It is whether the action is guided by process or by emotion. In investing, that difference can protect capital or slowly erode it. A written plan creates the framework that discipline needs. Without one, every market move feels like a fresh decision, and that leaves too much room for emotion and inconsistency. A useful plan defines entry conditions, profit-taking rules, loss limits, position size, and regular review points. Instead of reacting to every rally or decline, you can ask a simpler question. Does this situation meet my rules? That reduces ambiguity, which is important because vague decisions are usually where emotion sneaks in. A plan does not guarantee success, but it gives you a stable filter for action when the market becomes unstable. One of the most important mindset shifts in investing is understanding that a good process is more valuable than any single result. You cannot control whether one trade makes money, because short-term market outcomes always include uncertainty. What you can control is how well you prepared, how much risk you took, and whether you followed your own rules. A good trade can still lose money, and a bad trade can still make money. That is why following rules is a success in itself. Over time, discipline matters because it limits the influence of fear, greed, and random noise on your decisions. Rules are easier to follow when they are specific and measurable. Vague intentions such as buy good stocks or sell if I feel nervous leave too much room for interpretation when emotions rise. Clear rules are written in advance and describe exactly what must happen before you enter, how you will exit for gains or losses, how large the position can be, and when you will review it. The exact numbers can vary from one investor to another, but the standard should be repeatability. Specific rules reduce the need to improvise under stress, and the less improvising you do, the less room there is for emotion to quietly take control. Pre-commitment is one of the most practical ways to reduce impulsive behavior. It means making key decisions before emotions are high, when your thinking is calmer and more balanced. For example, you can set stop-loss levels early, choose take-profit levels in advance, determine position size before entry, and decide how often you will check prices. These choices turn discipline into a system, instead of a hopeful intention. When the market becomes stressful, the decision has already been made under better conditions. Pre-commitment does not remove all emotion, but it greatly reduces the chance that emotion becomes the final decision maker. Discipline becomes much easier when it is built into a routine. Routine lowers emotional intensity by creating structure around when and how you pay attention to markets. If you check positions on a schedule, review key events at set times, and prepare watch lists outside stressful moments, you are less likely to react to every headline or intraday move. Constant monitoring tends to magnify noise and invite impulsive action. A routine helps separate signal from distraction. In many cases, better investing comes not from watching more, but from watching more deliberately. Keeping a decision log is a simple habit with a powerful effect. When you record what you did, why you did it, and which rule was supposed to support the action, you create accountability. You also make it easier to see whether you actually followed the plan or only thought you did. Over time, the log reveals patterns, such as buying after exciting news, oversizing positions during strong markets, or breaking rules when volatility rises. That kind of self-observation is valuable because discipline often breaks down in repeatable ways. A decision log turns those weak points into visible patterns you can improve. It helps you learn from behavior, not just from outcomes. A disciplined investor reviews the plan on purpose, not in the middle of panic or frustration. Scheduled reviews create space to ask whether you followed your rules, whether those rules still fit your goals, and whether any of them are too vague to be useful. If changes are needed, they should be based on evidence and reflection, not on emotional reactions to one stressful event. That distinction matters because emotional tinkering can slowly destroy a good process. Improvement is important, but it should happen under calm conditions. In investing, the plan should guide the stressful moment, not be rewritten by it. Lena's example shows both the value of discipline and the cost of breaking it. She has clear rules. She buys only when a setup meets her moving average condition. She limits risk to no more than 2% on a trade, and she avoids chasing stocks after sharp rallies. That means she is willing to do nothing when the setup does not qualify, which is often a sign of real discipline. Later, however, she cancels a stop loss under stress and takes a much larger loss than planned. Her decision log reveals the real problem clearly, not bad luck, but a broken rule. The lesson is simple and important. Rules help only if they still govern behavior when emotions rise. Most discipline failures come from emotion, vagueness, or inconsistency rather than from a lack of market knowledge. Holding losers and calling it discipline is a common example, but that is often just stubbornness in better language. Rewriting the plan after one bad result is another mistake, because it confuses normal uncertainty with process failure. Some investors plan well on paper but fail to execute when stress appears. Others overtrade in volatile markets because activity feels productive, and vague rules invite emotion into every decision. All of this leads naturally into loss handling, because losses are often the moments when discipline is tested most severely. Section 4. Loss handling. Losses feel so hard because they trigger a strong emotional response that is often larger than the math alone would justify. In behavioral finance, this is called loss aversion. A loss tends to hurt more than a gain of the same size helps, and many studies suggest the emotional pain can feel roughly 2 to 2.5 times stronger. That pain can overpower fundamentals and push investors toward fast, uncomfortable decisions. Instead of asking what the investment is worth or whether the thesis still holds, the mind often shifts to one immediate goal: make the bad feeling stop. That is why losses can distort otherwise reasonable judgment so quickly. Loss aversion often leads to two opposite reactions, and both can be harmful. Some investors hold losing positions too long because selling would make the loss feel final, so they keep hoping for recovery. Others sell winners too quickly because locking in a gain feels emotionally satisfying and safer than staying exposed. In both cases, the decision is being shaped more by emotion than by objective review. The right response is usually neither automatic holding nor automatic selling. It is to pause and reassess the investment case, the valuation, the risks, and the role of that position in the portfolio. Better loss handling begins when feelings stop making the first decision. Investors often treat unrealized and realized losses very differently, even though the economic reality may be quite similar. An unrealized loss happens when the value falls while you still hold the investment. A realized loss happens when you sell below your purchase price. The emotional difference is important. Selling can make the loss feel final, while holding can create the comforting illusion that the loss is not fully real yet. But avoiding a sale does not erase the loss or restore value. The better question is not whether the loss has been realized, but whether the investment still deserves a place in the portfolio based on current facts. Good loss handling begins before you buy, when emotions are lower and judgment is clearer. That is the best time to decide how much loss you are willing to accept, what facts would invalidate your thesis, and what action you will take if those conditions appear. Writing those rules down matters because memory becomes flexible when markets are stressful. A clear plan might include a percentage limit, a dollar limit, a stop loss, or a fundamental condition tied to the business itself. The point is not to predict every outcome. It is to make sure your response to a loss is based on prior reasoning rather than on panic in the moment. When price falls, the most useful question is not simply, should I sell? It is, has the original reason for owning this investment changed? A lower price by itself does not tell you whether the business is weaker, whether the decline is temporary noise, or whether the market is reacting to something important. That is why it helps to separate price movement from the underlying story. Look for new facts behind the decline and ask whether they affect the thesis in a meaningful way. If the thesis is still intact, a drop alone may not justify an exit. If the thesis has broken, then continuing to hold may only reflect denial or hope. A simple process can make loss handling more consistent and less emotional. Start by setting a loss limit before entry while your thinking is calm. Write a specific thesis so you know what must be true for the investment to make sense. As new information arrives, compare those facts to the thesis instead of reacting only to price. If the loss limit is hit or the thesis clearly breaks, act according to the plan. Then review the decision afterwards so the experience improves future judgment. A repeatable process does not remove disappointment, but it does reduce impulsive damage. Losses should be evaluated at the portfolio level, not just at the position level. A 50% decline sounds severe, but the real impact depends on how large the position was to begin with. If that position was only a small part of the portfolio, the damage may be manageable. If it was a very large holding, the same price move can have a much more serious effect on total wealth. That is why position sizing is one of the most important forms of risk control. Rebalancing also matters because it prevents one holding from becoming so large that a single loss distorts the entire portfolio. Consider a disciplined example. An investor buys a renewable energy stock at $50 with a 15% loss limit at $42.50. When the stock first drops to $45 because of a regulatory delay, the investor does not react automatically. Instead, they review the new information and conclude that the original thesis still appears intact, so they continue to hold. Later, the stock falls to $40, which clearly breaks the loss limit. The investor sells, realizes a $100 loss on 10 shares, and then rebalances the portfolio. This is disciplined loss handling because the action followed a plan and a thesis review, not emotion. Losses become much more useful when they are reviewed without self-criticism. The first question is whether you followed your process, because a good decision can still lead to a bad outcome. Then ask whether the thesis was flawed, incomplete, or based on assumptions that turned out to be weak. It is also worth checking whether the position size was appropriate for the risk involved. This kind of review separates normal investing uncertainty from genuine decision errors. That matters because self-blame is not the same as learning. Calm review improves future decisions. Harsh judgment usually just increases fear. Several common mistakes make loss handling worse than it needs to be. Waiting to sell until you get back to even is one of the most common, but the market does not care where you bought. Averaging down without a clear plan can also increase risk at exactly the wrong time. Ignoring portfolio-level exposure makes losses more dangerous than they appear at first glance. Mental stops are another trap, because unwritten rules are easy to abandon under stress. And watching price alone while ignoring the thesis leads investors to react to noise instead of evidence. Avoiding these traps helps set up a healthier long-term mindset. Section 5. Mindset. Investor mindset is the set of beliefs and habits that shapes how you interpret information, handle uncertainty, and respond to gains and losses. It is deeper than a tactic or a trading trick. A good mindset supports rational, consistent decisions when markets become noisy or uncomfortable. It influences whether you react impulsively or stay grounded in your process. In that sense, mindset is a foundation rather than a shortcut. Strong habits of thinking do not guarantee quick profits, but they do make disciplined investing far more likely. A healthy investor mindset puts more weight on process than on any single outcome. Short-term results always mix skill and luck, so a careful decision can lose money and a careless one can make money. If you judge only by profit or loss, you will often learn the wrong lesson. Profitable mistakes can teach bad habits, while normal losses can make good habits feel questionable. That is why investors benefit from reviewing decision quality instead of chasing emotional satisfaction from recent results. Over time, process is what gives outcomes a better shape. Outcome matters, of course, but process is what makes good outcomes repeatable. A process-based mindset is built on repeatable questions. Before and after a decision, it helps to ask what information you actually had, whether your reasoning was sound, and whether you understood the main risks. You should also ask whether the decision fit your portfolio and your time horizon, because a good idea in isolation may still be a poor fit overall. Finally, ask whether you followed your own rules. These questions create consistency across many different market situations. They help keep judgment anchored in evidence rather than in mood. When emotions are running high, simple questions like these can restore clarity. Thinking in years instead of days can significantly improve investor behavior. Daily price moves are often driven by headlines, sentiment, and short-term trading pressure more than by long-term business value. When investors focus too closely on those small movements, they often give noise more meaning than it deserves. That can lead to chasing surges, selling in panic, or mistaking normal volatility for a serious problem. A longer time horizon changes the emotional experience of investing. It helps you see fluctuations as part of the process rather than as constant signals to act. Humility is one of the strongest qualities an investor can develop. Markets are complex, outcomes are uncertain, and certainty is rarely justified for long. Humility helps investors diversify instead of overbetting on one idea, manage risk even when they feel confident, and update their views when new facts appear. It also makes learning easier, because mistakes become information rather than threats to identity. Overconfidence pushes investors toward concentrated risk and stubborn thinking. Humility leads to durability, flexibility, and better long-term survival. Sometimes the best decision is to do nothing. A mature investor understands that activity is not the same as progress, and motion is not the same as improvement. Quiet markets can tempt overtrading because inactivity feels unproductive. Stressful markets can trigger impulsive selling, and exciting rallies can trigger impulsive buying. In all three cases, acting may provide emotional relief without improving the portfolio. No change can be the correct decision when the original plan still makes sense. Often the real skill is not knowing when to trade, but knowing when not to. Mindset becomes truly useful when it is turned into a routine. Writing down your investment philosophy helps clarify what you believe and how you want to act. A decision checklist makes those beliefs practical at the moment. Choices are made. Reviewing process separately from outcome keeps luck from distorting your lessons. An investment journal captures your thesis, risks in emotional state so patterns become easier to spot, and a regular review schedule keeps reflection calm and deliberate instead of reactive. Together, these habits turn mindset from an abstract idea into something you can repeat. Maria's example shows what a strong mindset looks like under pressure. She bought a technology company after careful research, and when the stock fell 15%, she did not react to the price move alone. Instead, she paused and revisited her original thesis. She asked the right question: did the business change or only the market price? Because the company's long-term strengths and core fundamentals still appeared intact, she chose to hold. That decision was not passive. It was thoughtful and process-driven. Good mindset often shows up not in dramatic action, but in calm restraint. A strong exit plan is based on fundamentals, not just on discomfort with price movement. One useful exercise is to write down exactly why you entered the investment in the first place. Then name one fact that would genuinely make you exit, such as deteriorating earnings, a broken business model, or a major change in risk. This helps separate a true exit strategy from a reaction plan. If your reason to sell is mostly that the stock moved sharply or that sentiment feels negative, you may be responding to noise rather than to substance. Testing your exit plan in advance makes it easier to act for the right reasons later. Several mindset traps appear again and again in investing. Overvaluing recent outcomes can make one good month feel like proof of skill, or one bad month feel like total failure. Confusing noise with signal causes investors to treat headlines and daily volatility as if they were deep information. All or nothing thinking pushes people toward being fully in or fully out instead of making balanced portfolio decisions. Impatience with the process can lead to abandoning good habits before they have time to work, and feeling pressure to act can make unnecessary movement feel wise. The goal is not perfect psychology. It is steadier thinking, especially when markets feel noisy, uncomfortable, or urgent.